Imagine planning your retirement years carefully, anticipating your Social Security benefits, only to find out a portion of them might be taxable. It can be a real surprise for many people. Well, this is where provisional income comes into play. Provisional income is a calculation used by the Internal Revenue Service to determine how much of your Social Security benefits, if any, will be subject to federal income tax. It is essentially your modified adjusted gross income for this specific purpose. To calculate your provisional income, the Internal Revenue Service asks you to add up a few specific things. You take 1/2 of your total Social Security benefits for the year, and then you add all your other taxable income. This includes things like wages, self-employment income, interest, dividends, and distributions from pensions or traditional individual retirement accounts. On top of that, you also add any tax-exempt interest you might have, such as interest from municipal bonds. Once you have this total, you compare it to certain income thresholds. For single filers, if your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits may be taxable. If it is above $34,000, up to 85% may be taxable. For those married filing jointly, the thresholds are $32,000 and $44,000. This calculation helps ensure that those with higher overall incomes contribute to the tax system, even on their Social Security benefits. So how do you figure out your own provisional income? First, gather all your income statements for the year, including your Social Security benefit statement, which you will receive from the Social Security Administration. Next, identify your total Social Security benefits and calculate half of that amount. Then, sum up all your other taxable income sources. Finally, add any tax-exempt interest. Add these 3 figures together, and that is your provisional income. This number will then show you where you stand against those Internal Revenue Service thresholds. While you can do this calculation yourself, many people find it helpful to use tax preparation software or consult with a qualified tax professional to ensure accuracy. Understanding this term, provisional income, really is an insider detail in retirement planning. It is more than just a number. It is a critical tool for strategic tax planning. For example, some people consider the tax implications of converting a traditional individual retirement account to a Roth individual retirement account, as distributions from a Roth account are typically tax-free and do not count towards provisional income in the same way traditional individual retirement account distributions do. Knowing how different income sources impact this figure allows you to make informed decisions that could potentially reduce your taxable Social Security benefits, putting more money in your pocket. Ultimately, provisional income is the key metric that dictates whether and how much of your hard-earned Social Security benefits will be taxed by the federal government. By proactively understanding how it is calculated and what factors influence it, you can better manage your overall tax liability in retirement. This knowledge empowers you to plan confidently, ensuring you maximize the benefits you receive and avoid any unexpected tax burdens, leading to a more secure and predictable financial future.